are back. I'm very happy to have on the Goldstein on Gelt show Eswar Prasad, who's a professor of economics at Cornell University, and he's the author of the new book, The Dollar Trap, How the U.S. Dollar Tightened Its Grip on Global Finance, which just came out from Princeton University Press. Eswar, real pleasure to have you.
My pleasure to be on your show, Doug.
So in the book, you actually argue a number of points which seem very controversial, and I expect that you're going to get a lot of flack if you haven't already for things you've said. And one of the main issues that you're talking about is that the dollar is stronger than ever. Is that really true? Because certainly the anti-dollar people are always quick to show you a chart of the dollar decreasing over decades.
Certainly the notion of the financial crisis creating a problem for the dollar, both in terms of its value and its prominence as an international currency, makes a lot of sense, apparently. If you think about it, the financial crisis had its origins in the United States. Since the financial crisis, the U.S. Central Bank, the Federal Reserve, has pumped a huge amount of dollars into the global financial system, which should in principle reduce the value of the dollar. And the U.S. has issued an enormous amount of government debt. In principle, this should all weaken the dollar. But remarkably, what has happened is that the dollar's prominence as a global reserve currency, as I argue in my book, has in fact strengthened. Now, why is this? The reality is that there is a lot of turmoil in global financial markets ever since the crisis. There have been repeated problems, including the Eurozone debt crisis, and every time there is turmoil, people want safety. Central banks in emerging markets want to keep a lot of money for a rainy day. Private investors want a safe place to put their money. And because of regulatory changes, financial institutions like banks are being asked to hold more safe assets. Now, what are these safe assets? They are largely government bonds of the major advanced economies. Now, we know that the Eurozone doesn't look as safe as we once thought it was. There is only a small part of it that really looks safe. So a Greek bond is clearly not the same thing as a German Bund, for instance.
Not today.
Japan and Switzerland don't want money coming to the economy, so who's left? The US dollar. So people coming to safety are coming to the US dollar, and that's what is leading to its remaining strong, both in terms of its value and its prominence as a global reserve currency.
Can you distinguish between the two? When I asked my question originally, I asked about the strength of the dollar, and you answered by talking about it being a reserve currency. What's the correlation between those two concepts?
The dollar's value is not necessarily the same thing as its being the global reserve currency. So in fact, before the financial crisis hit, the dollar was actually depreciating, that is falling in value, against the other major currencies of the world at the rate of about 1% a year. Now, since the financial crisis, the dollar's value has gone up and down, and right now the value on a broad basis against its major trading partners is roughly where it was back in 2007. But if financial markets settle down, it's likely that the dollar will continue the decline in its value, especially relative to emerging markets like China, which are growing faster, have higher productivity growth. But that is not inconsistent with the dollar still being seen as the safest investment. So the U.S. Treasury securities, that is government bonds that the U.S. issues, are still seen as the safest and most liquid instrument. Why? Because there is a lot of it around, and the world seems to trust the U.S. government that it will eventually pay back those obligations.
So it's safe against default, but it's not necessarily safe in terms of an investment. If you're looking, you would not necessarily buy dollars versus euros or sterling or yen. In other words, the safety is there, you're describing, but not necessarily in terms of a long-term value.
If you were looking for good returns, you would certainly not buy U.S. government bonds. U.S. government bonds are paying very low interest rates. In particular, if you look at the long-term bonds that many foreign central banks and foreign investors are buying, and they're buying a lot of them, those are paying very low rates of return. And if you add to that the notion that other currencies, say the Chinese currency, is likely to appreciate against the US dollar, that means that foreign investors are willing to accept fewer units of their own currency when the US finally gets around to paying this off. So the world seems to be willing to pay a very high price for safety.
Mhm. We are talking with Eswar Prasad, who is the author of the new book, The Dollar Trap, How the U.S. Dollar Tightened Its Grip on Global Finance. And in a very turbulent past several years, Eswar argues in his book that the U.S. dollar continues to be the reserve currency in the world. And we were talking about the dollar against other currencies. How about against gold?
Now, gold's value increased quite significantly a couple of years ago, and it's fallen back quite substantially since then. Now, there is a lot of faith in gold, partly because there is a limited supply of gold. Right now, there is about 165,000 metric tons of gold that has been mined, and about another 50,000 metric tons is believed to be underground. So the notion is that if gold is in limited supply, perhaps it will maintain its value much better. But ultimately, the price of gold, which is now about in the range of $1,200 to $1,300 per troy ounce, that is also built on faith because it's not really an intrinsic value. And what we have learned since the financial crisis, in fact, is that what seems to be really valuable are currencies, fiat currencies issued by governments that can be issued in very large amounts. That is where the supply is quite elastic, that is, it can adjust to demand, whereas gold supply cannot be adjusted to demand. So that's the allure of gold, limited supply, but we are learning that if we had a gold standard where money was backed by gold, we would actually be in even deeper trouble because we wouldn't be able to generate the amount of liquidity or money that's needed to prop up the financial systems during a bad period.
Well, if gold doesn't have an intrinsic value much, certainly currencies have even less, no?
That's exactly right. The whole notion of fiat money is built on trust. And the issue here is that if you think about gold or even bitcoins, there is no national government or an institution that is behind those financial assets. Whereas behind the dollar, there is the U.S. Central Bank, the Federal Reserve, and behind the Fed stands the U.S. government. So there is a notion that because the U.S. government has the ability to raise taxes and generate revenues, that ultimately its backing means a lot more. But ultimately, fiat currencies and these other stores of value are to a very significant extent built on faith.
Okay, so now people's faith is certainly being tested with the largest debt ever in the United States history, and it seems to continue to increase over time. Isn't that a warning sign?
It should in principle be a warning sign, but here is the number. Since the financial crisis, the U.S. has issued about $5.5 trillion worth of government debt. This is between 2007 and now, and this excludes the amount that has been bought by other parts of the U.S. government and by the U.S. Federal Reserve itself. Now, of that 5.5 trillion, it turns out that nearly 60%, or about 3.3 trillion, has been bought by foreign investors. And again, this is the paradox. Any time that there is turmoil in global financial markets, whether it's caused by emerging markets, whether it's because of troubles in the Eurozone, or most interestingly, because of troubles caused by the U.S. itself, that seems to cause investors worldwide to come to the U.S. dollar in search of safety. And this is the great paradox we're facing in international finance, that when the U.S. is the source of the troubles itself, money still comes to the U.S. in search of safety, simply because there is no other place to go.
That's like when they lowered the rating on the U.S. Treasury bonds, the price of the bonds actually went up. Which was, I think,
that's right, and we've seen it repeatedly. Every time there is a problem about the debt ceiling, political gridlock here, the yields, that is the interest rates on U.S. Treasury securities actually fall, and the U.S. dollar strengthens. And this is historically unprecedented, that the country that is in the midst of these troubles causes problems. Now, this is really not a story about American exceptionalism. It's not because the U.S. is necessarily in terrific shape, but in international finance, it turns out everything is relative. And if you look at the size and depth of its financial markets, the trust in its public institutions and its legal framework, the U.S. still seems to stand head and shoulders above other countries.
What about the issue that you started to touch on before about interest rates? If interest rates were to move up, which of course is controlled to a great extent by the Fed, but there are also market forces at play. Would that make the U.S. have a nearly impossible time to service this large debt?
Now, it depends why interest rates were to go up, because you would expect interest rates to start rising if the U.S. economy does well and if the Federal Reserve does start pulling back some of its quantitative easing operations. It's because the U.S. economy is strengthening. So that would be a very natural process. And that, of course, would lead to higher debt servicing costs, and that would create some fiscal problems for the U.S. But an alternative scenario is one where investors start getting worried about the level of debt. They start getting worried about rising inflation in the U.S. in the future. So inflation expectations, which have been remarkably tame so far, start rising very rapidly. That would not be so good. But again, we return to the paradox, because if all of a sudden investors in the U.S. get very worried about inflationary expectations, that's going to lead to turmoil in U.S. financial markets. And when there is turmoil in U.S. financial markets, immediately there is turmoil in the rest of the world itself. And when there is turmoil, what do? You want safety. So there is a self-correcting mechanism, because once there is turmoil created by the U.S., money would once again flow into the U.S. and keep those interest rates at the long end down. There is no escaping from the dollar right now.
It's just a question of how long that paradox can continue. We have been talking with Eswar Prasad, who is the author of The Dollar Trap, How the U.S. Dollar Tightened Its Grip on Global Finance, a real fascinating read and certainly counter to a lot of what we're all hearing in the media today. Eswar, in the last few seconds, just tell us, how can people follow your work?
I have a website for my book. It is thedollartrap.com. That has a lot of information about the book, including a number of interviews and so on, so you can learn more about the book, how to order it, and further information about how the book was written and so on, all at that website, thedollartrap.com.
Okay, so that's great. We will also put a link to that at the show notes of goldsteinongelt.com. We've been talking to Eswar Prasad, an economics professor at Cornell and author of The Dollar Trap. Thanks so much for your time.
Thank you very much for having me, Doug.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.